In this presentation, we're going to look at a debt for equity swap. And for our example here, we have bonds payable, or those are bonds outstanding, and their liabilities here on the balance sheet. And what we want to do is reduce the amount of these bonds payable or liabilities and swap them for stockholders' equity in the company, or increase our equity account here by reducing our liabilities here. And we're going to do that by offering our bondholders equity stock or common stock in the company for exchange of the bonds that they're holding. And we start out here with our example here of $100,000 face value of bonds that we issued, and at that time we received $104,100 for them. So what we needed is a balancing entry here between the cash and the bonds payable. So we use this valuation account here, a premium to bonds payable, and that increases our bonds payable amount. So we credited that here for the balancing amount here of $4,100. Now we amortize that down to the point here where the premium account is $2,674 here, and the carrying value of the bond at that time would be $102,673. So we're going to use that as our base here for our conversion of those bonds here. That would be the carrying value we're going to use. Here I'm going to compare the book value method with the market value method in this debt to equity swap. And we're going to start here with the book value method. So looking at our numbers here, the bondholders converted $40,000 worth, or 40% of those convertible bonds, into common stock. So the number of bonds converted here would be the $40,000 worth divided by $1,000 per bond, or 40 bonds were exchanged here. And then the number of common shares issued here would be 40 bonds times 10 shares per bond, or we offered the bondholders 10 shares for each of the bond that they held. So that amount here would be 400 common shares issued here. So we have reduced our liabilities here in our bonds payable and premiums to bonds payable by 40%. And these are the carrying value. In this case, the premium to bonds payable, that was our carrying value here, that was reduced by 40%. So we decreased our liability here a total of $41,069. So going over here to the exchange for the equity in common stock here, we would credit here to common stock at its par value here times $400 for $2,000 here. And then our additional paid in capital to common stock, that's based on the carrying value of the bonds less this par value here. So the carrying value would be $41,069 less the $2,000 here for $39,069 here, total additional paid in capital. So looking at our equity accounts here, we increased their equity by $41,069. So by converting these bonds here from a liability into stockholders' equity, we had an exact here balance between the reduction in our liabilities and our increase here in the stockholders' equity. And this is using the book value method. And this book value method here is based on the carrying value of the converted bonds for calculating our additional paid in capital, or the stock equity that we calculated in this exchange. Now we'll look at the market value method for this debt to equity conversion. And we have the same number of bonds converted and shares issued as before. So we would reduce our liabilities here in our bonds payable and our premium bonds payable by 40% times their carrying value. So our decreased liabilities would be $41,069 in this case. And then for the bonds that were exchanged for the common stock, we would increase our equity account here, or common stock, times the number of shares in this case times their par value here, and it would be $2,000 in this case here. And then our additional paid in capital to common stock, this would be based on the market value of that stock, or the issue price of that stock. This is where the market value comes into effect here. So we take the number of shares times their market value or issue price less the par value here, and we come up with a $31,200 amount that we have as additional paid in capital here. So our credits to the stockholders' equity here would increase our equity by $33,200. And comparing that to a decrease in liabilities here of $41,069, we have to come up with a balancing amount here. And that remainder would be recognized or a gain or loss here in net income on the income statement. And in this case, it would be a gain. we're taking the bonds carrying value at the time of the conversion less the market value of the stock here. That's what the issue price of that stock was, and in this case it was $41,069 in this liabilities account here, less the $33,200 in the equity account here for the stock, and the difference here was $7,869. So we would recognize a gain here, or we would credit our revenue account for that amount. So in this market value method, we use the issue price here, or that market value, for calculating our additional paid-in capital when we made that exchange here of the bonds for the common stock. All right, let's summarize the difference here between the book value and the market value method for this debt to equity swap. So in both cases here, the reduction of the liabilities was by the carrying value of the bonds that were converted. The difference here comes into how we valued this stock at the time of the conversion here. So looking first here at this book value method, we decreased our liabilities by $41,069, and we increased our equity by the same amount here. Now that was based on the book value, or the carrying value, of those bonds converted here that we shown here in our additional paid-in capital on that common stock. Now, in looking here at our market value method, we decreased our liability by the same amount as the book value method, but we increased our equity account here only by the market value of the stock issued. So that was our difference here between the book value and the market value method. Now, the difference here in this market value, we had to account for this decreased liability of $41,069 versus the increase in equity here of $33,200. So the remainder, or the difference here, goes into a gain or loss account that we recognize in net income on the income statement. So in this case, we calculated a gain here. We take the bonds carrying value minus the market value of the stock. And the difference here was $7,869 that we credited here to our revenue account as a gain. Now remember, this revenue account gets closed to the retained earnings at the end of the period. So the $7,869 here gets closed as a credit here to retained earnings of $7,869. So if we look here, the difference between the market value and the book value as determined here in the shareholders equity account, there really isn't any difference once you add in this retained earnings here into this market value equation here. So the $31,200 of the market value of stock issued plus the retained earnings that we recognized on that exchange equals the and the par value of the stock equals the $41,069 in shareholders equity. And then the book value amount was for the same amount here, $41,669. So the difference here between this book value and market value is how we evaluate here this stock at the exchange date. And then any difference here in this market value method got closed out to retained earnings. So that's a summary of how the difference between the book value and the market value on these debt to equity swaps.